Duncan, you kick it off, introduce the two managers, and then Suzanne, you'll tell us if you think they're interesting. Fair?
Because I think I'm better off on the side. Suzanne, next.
All right, here we go.
Okay. Thanks, Mark. I think you guys have heard me at times express the point about credit in an uncertain world. Just as a reminder, fixed income and credit, it's a contracted return, a specific return to a specific date. And I think in an uncertain world, it's an interesting place to spend some time. Secondly, sometimes when people talk about fixed income, they're worried about the duration risk. You could have bought the zero coupon ETF 2 weeks ago, and you would have made 5%, which is by today, which is more than the yield of the instrument you might have bought. So what we want to talk about is how do you participate in that market without actually having to absorb all that risk? So I've spent a long time working in Europe. I've known Malik and Dan for a long time. Both of these guys bring very specialized niche market knowledge. And in my view, it's the kind of niche that doesn't actually exist in the United States. And so when, people don't wake up in the morning and say, hey, I've got to invest in European credit or fixed income, but actually maybe you should think about it a little bit. So with that, I'd like to first ask Malik to introduce himself briefly, and then I'll ask Dan to introduce himself, and then we'll get into a conversation.
Thanks, Duncan. I started my career 20 years ago. I grew up in the credit derivatives world, CDS, credit default swap, which at the time was a young market that has grown before the financial crisis, and then being placed in hands of specialists after the financial crisis, thanks to the regulators. I've done investment banking. Then in 2008, we started. I was founding partner at Chenavari, a European credit hedge fund specialized in all sorts of niche specialized strategies. We grow up to 5 billion. And then from 2021, I started Ancora Investment in London. In a way, the philosophy is to go away from the hedge funds world to be trying to democratize access to a specialized market in credit derivative and precisely structured credit derivatives where you do tranches on CDSs.
Okay, thanks. Dan?
Hi, thanks for having me. I've been in the credit markets, both private and public, for about 25 years, most of the time in Europe, looking at various types of things, mostly in the total return space rather than the pure carry space or portfolio space. Most recently, I set up my own firm to exploit some niche strategies within credit markets. I really call it credit in special situations. There are equity opportunities within the strategies that I do. And, a lot of people have come up here and said, why care about Europe? Europe stinks. I don't disagree with the macro backdrop. I think it's a really tough one. But the more investors that stay out of Europe, the better it is for me. There's more stuff to do. So I kind of welcome hearing that sometimes, which means more for me. Thanks.
Suzanne, do you want to say a few words?
This is on. Yeah. Hi, I'm Suzanne Murphy. I have my own family office, as well as work for a family office that's relaunching a fund that we ran in the special situations event-driven space in the lower middle market, but all US. And my background's in credit. I was a partner of a firm at a firm called Claren Road, which we sold to the Carlyle Group years ago, which was a more liquid, long, short credit strategy. So I have a lot of background in the credit space. Now I'm really going to date myself, right? I started my career at Drexel. So that tells you how far back I go in credit.
Thank you. Well, so I guess the first question is, why is it that a niche strategy is better than some large credit strategy? And maybe, Dan, do you want to answer that one first?
Sure. One thing about the last panel, the private versus public markets panel, in credit, markets are converging, right? The private credit market and the public credit market are converging. And I think what you've seen in private markets in credit were pretty attractive returns. I think those are going away. I think the market structure is changing. It's very, very competitive out there. There's one big firm that did a huge raise for their latest fund in Europe. That's going to be just a deployment machine, right? It's not a total value machine. It's probably not a great risk management machine. It's a deployment machine. It's 50% leverage. It's more aggressive than most vehicles have been in Europe. So the market's changing quickly. Some people argue that it's the first step towards a CLO in private credit. I'm not sure if I go that far, but things are converging. So spreads are at all-time tights, right? And I think if private credit is moving in that direction, the way you get on the efficient frontier of maximizing returns is finding niche strategies. I think your slide of the efficient frontier of returns, private credit is one of the top things, right? If that starts dropping, you got to find some other things to do.
Malik?
I agree with the,
Sorry,
you go
I
ahead.
would also add vis-a-vis private credit, right? There's been so much growth in that business and there's so much competition and there's some very good underwriters and some very bad underwriters. And there have been some things underwritten in the past few years that are going to cause real fallout in that space. And it's sort of, you can talk about AI getting ahead of itself and then they're being crashed. Like private credit has gotten ahead of itself to a certain extent as well. And in
Yes.
Europe, I think you have to be very careful about jurisdiction and rule of law, which is a little bit different than here.
Absolutely.
Yeah, so I agree with Dan. We've seen a strong rally in the market, whether in equities or credits. And historically, alternative and private credit tend to outperform traditional credit investments over medium range when we are at the peak. I think the most recent similar environment in terms of strong rally we've had post-COVID, so mid-2021. And if you look at the performance of total return swaps, Bloomberg high yield corporate credits, it's low single digits, while private and alternative credits manage an average a good double digits. That doesn't mean when there is a strong rally, so or the rally continues or stays similar to the same levels, traditional credits, public and private and alternative credits tend to do the same. So you're kind of having more consistent performance out of these niche asset classes. Why? We've got less competition. So there is a premium behind illiquidity. There is a premium behind complexity in a way. So what we trade, what we invest in is not something that you can find in your Bloomberg. You can trade directly. It's not something that your broker would show you. So all the crowd is not there. So less competition is more opportunity and more arbitrage that we can grasp from.
Suzanne, maybe you can add a little color to that. Again, talking about the investment opportunity of a smaller manager exploiting higher return opportunities.
Yeah, listen, I mean, we tend to, from the family office perspective, investing like niche managers, like smaller managers, like emerging managers, they tend to outperform over time. Again, due diligence. You really have to do the work, which is a lot harder on a niche manager. But I think niche strategies, particularly in credit, are very attractive because of the have-nots, right? Banks are still lending to large companies, but you've got Basel Endgame coming. The regional banks have been incredibly hamstrung by the troubles that we know have happened over the last year or so. And so there are a lot of companies out there that don't have access to capital, right? Who traditionally lent, certainly in this country, I'm less familiar with Europe, but who traditionally lent to the smaller companies. It was regional banks. It wasn't JP Morgan. And they are not lending. So that's been part of why we've seen such a huge growth in the private credit markets. So I think the ability to get higher returns lending to smaller companies or investing in nichier things is there. The other thing I would just caution about is just be really cognizant of underlying leverage, right? And what that means. I mean, I was on a panel at a different family office conference a couple of months ago, and it was me and a bunch of real estate guys. And we were talking about returns in the credit space. And, I was like, okay, well, I'm talking about unlevered returns. You've got 3 or 4 turns of leverage. So it's not apples to apples. I will say also vintage is important, particularly in private credit, less so for what I think you guys are doing because it's more publicly oriented, it sounds like. But I also think one very interesting area, speaking of real estate, is going to be real estate lending. I'm looking at a manager right now who just left BSD, MSD, which was the combination of Michael Dell's family office with Warren Buffett's former banker. They formed an OCIO business, and this guy co-ran the real estate credit business there for, I don't know, 5 or 6 years. He was there for like 14 years, and ran a bunch of different businesses, but he has spun out and is launching a new real estate lending fund, which I think is really interesting because he's got a totally clean balance sheet, right? I wouldn't want to be buying it necessarily a secondary. I mean, there's a price for everything in a real estate lending fund with a lot of bad stuff from the last 5 years. But I think right now going forward, if you've got somebody who can do good underwriting, that's an interesting niche space as well.
I might
I would
just
also,
start.
one
oh,
other thing, I would also add, a lot of the big credit asset managers have grown so much, right? And, growth in European markets hasn't been probably as robust. So, you get guys who used to be very specialist credit guys that would do small deals, sub 100 million, those kind of things where there is good value. Now those guys don't do anything for less than 500 million.
Well, and
So
they'll
it leaves a space.
And they'll tell you that. Last year at the iConnections, I think it was last year at the iConnections conference, there was a panel with Mark Lazary from Avenue, Josh Friedman, Mike Arrighetti from Ares, and the guy from Apollo, whose name is blanking. He'll kill me because he's a friend of mine. But, and they're all sitting up there saying, we're all competing against each other for the same deals because there just aren't that many deals. And we're bidding up prices and we're paying too much. So they'll tell you that.
Yeah, it's true. Yeah.
They just have, because they've got to put the money to work, and they raised so much money in the falling knife trade of COVID and didn't get the money out. And so they're under a lot of pressure to deploy, and there just aren't enough deals for the bigger guys. And the stuff that you guys are doing, and again, the opportunity, because it's underfollowed, overlooked, et cetera, is it doesn't move the needle for them. I mean, Josh Friedman has looked at what we're doing and said, I wish I could do what you guys do, but it just doesn't move the needle for me.
I may add, Duncan, just before I give you that. So we talk about performance, realized performance, forecast of performance, and we tend sometimes to forget about risks. I think the most important piece, like before the financial crisis and after, is that leverage has moved from investment banks to large asset managers. And the leverage play works until it doesn't. So we don't, I'm a bit bullish for the next 12 months and 18 months, like I think everyone else, but you don't know where leverage could be. And I think in our niche markets, we have the capacity to generate double digit returns without leverage. And that's quite unique, while traditional credit and large asset managers would actually jump into using any leverage they want. And it works until it doesn't.
Well, just look at over cycles, how many times the carry trade has blown up, right?
We're going to have to run here pretty quickly, I think, but I guess a lot of the news, if you've followed, the disasters we've had with the hurricanes and the flooding and the fires, one example is that where there's a lack of capital is in the peril space. Dan's been working on something there. Maybe you want to just reference that in case.
Sure. Look, that's a good example. I mean, London, there's a Lloyd's of London kind of, organization that's very good at insurance underwriting. I've organized a team to target a specific part of the reinsurance market that's underserved in catastrophe risk. Returns we're getting are well into the 30s on an unlevered basis. Very interesting space, not a lot of capital. Big credit guys don't want to go after it. Very, very interesting opportunity. Very short term, 100% deployment. There's a lot of positive things, and those are the types of niches that I'm trying to target, which are very unique, offer people a very distinct kind of investment opportunity, not just here's a fund, hopefully you can invest it in 5 years.
Are you doing that in a special vehicle or?
Yeah, it'll be in an SPV, probably in Bermuda. And returns are great, but these niches are out there. And like I said, the capital formation in London for these special situation type things isn't there because of all the reasons we've said. So Europe, for that reason, is pretty attractive.
And Malik, correct me if I'm wrong, but the derivatives market led the cash market in Europe, whereas the U.S. market has been really built from cash and learned derivatives. So that's probably left us with a derivatives market in London that's smaller than it probably was 15 years ago, it's left you with niche opportunities there that are,
Yeah, I think the cultural trading in Europe started with structured and derivatives equity in the 1995 with a large institution like SocGen playing a lot with structured equities and derivatives. Then the credit derivative started in 2002 with most investment banks, even the US one, having their base in London. So the culture, you have all those players very familiar with the derivatives. I think the US is more cash. I think that the nice thing about derivatives is that you can choose any corporate you want, any maturity you want, and we use fixed maturity. It's something that you mentioned initially, Duncan. So we're less sensitive to the trajectory of spreads between now and the maturity of the investment. So if you do 3 to 4 years, medium term, your total return target investments is immune to where the spreads will land. We invest in default exposure, like a pure educated, selected default exposure rather than trajectory of the spreads. So that's a good advantage. Also, something is quite unique in Europe when we trade derivatives, we do Europe and US. So why? I think the dilemma is Europe a good time to invest or not? Well, Europe is the closest market in terms of transparency to the US. So in terms of educating your investors and looking at the transparency of your companies, it's very strongly regulated. So there is rule of law. It's complex, but there is there. And it's quite, and also, I think the best thing is to do the best of the two worlds. We in the derivative space, if I have an 80 credits, I will certainly not venture with high yield US because we do high grade type and you can have plenty of transparency in the US company. The same applies to European companies where you're in the high quality credits. And then you have more regulation in Europe. I think that's an opportunity we had. So I don't know if you guys are familiar with CRT, SRT. It's started in Europe. So that's another type of banks issuing derivatives into their own portfolio because the regulator is relieving RWA, risk-weighted assets. And that market has grown, started in Europe, and now CRT starting in the US, and it reaches 500 billion pretty quickly because of the banks. That's not what we do. We tend to be more into more niche where we have full freedom to select our credits rather than having the bank dictating their portfolio, but it gives you the atmosphere of investing in derivatives from Europe.
Suzanne, the last word before we go to breakouts.
God, that's a lot of pressure. Listen, I've always liked credit markets. There's generally opportunity. I mean, we are not in the camp that the Fed is going to continue to lower rates. We are in the camp of higher for longer. At this point, given what we're seeing in inflation and employment and other things, I don't think Trump, standing up and saying, I'm going to insist rates go down. Jerome Powell doesn't care. Okay. Like he doesn't. He happens to belong to my mother's golf club. She sits next to him all the time. But I do think when investing in credit, like, again, you've got to really think about leverage, underwriting in Europe, particularly jurisdiction and rule of law, because unlike the United States, where it's kind of one size fits all, like France is different than Greece, is different than England, is different than Germany, and, et cetera. So, you really want to understand what jurisdictions a European manager is investing in. But overall, I think there's a lot of opportunity in the credit markets going forward, but you just have to remember credit people are glass half empty people.
Yeah.
Equity people are glass half full people.
Complexity of Europe is the opportunity.
Yes,
So
because
I
you
think
need to
most
be
people are
more
afraid of
specialized,
it.
100%.
if you know it well, it's the opportunity. You'd say the same probably.
All right. Well, thanks, you guys.
Thanks, Duncan.
Wait, we're 3 minutes early?
Trying to get you on schedule.
All right, well, let me just explain what we're doing now. There are breakout rooms. If you want to continue this conversation, you actually don't move. So Duncan, you're listening to this? Your group is going to stay right here. Figure out your tables. You'll see there's a breakout room 1 for venture, 2 for private equity and public markets. Sorry, 3 don't move. 3 is actually here. 4 is rest of the world. 5 is LATAM. So they're all around. The one mistake I have is putting credit down twice.
Come join our 361 firm community of investors and thought leaders We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.